Hello, chart watchers, and welcome to this Friday, April 20th Market Watchers Live show with your hosts, Tom Boley and Aaron Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Happy Friday to everybody. Looking at the market, we got the Dow Jones currently down 177 points, trying to hold on to the support area near 24,500. We are just below that level currently. The S&P 500 down 19. The Nasdaq is down 78 points. It's fallen below the 7,200 level and is challenging some gap support from earlier this week. The Russell 2000 also falling, but holding up pretty well on a relative basis, down just 5 points. And I think just looking at these four charts going across here, you can see on a relative basis, the Russell 2000 has been holding up the best and is not too far from that second week high in March. The 10-year Treasury yield continues to move higher. We did move up near 295 earlier today. We are currently sitting at 2.93%. Talk about that a little bit more in just a few minutes. Volatility is back on the rise. Not a huge move higher with all the selling we've seen today, but the volatility index is up about 4.4%. Technology really struggling today. You can see it down 1.37%. It is the worst performing sector. And a lot of that is due to Apple, which is down nearly $6 today. And moving in on that late March, early April support level near 165. Consumer staples continue to take it on the chin, down another 1.4%. Brewers today losing support. This one does have a positive divergence if we could get a reversal, but it's going to take some work by the end of the day. GE, believe it or not, the top or one of the top performing S&P 500 companies. GE reported its earnings. We'll talk about that in just a bit, but a nice positive response with some solid volume on GE. And then the worst performer in the Nasdaq 100 is JD.com, broadline retailer, also down testing some key support from a couple of months ago. We'll see whether or not JD can hold on to that support. And with that, I will bring in my co-host, Aaron. How's it going this Friday morning, Aaron?
It's Friday, so everything is going just great. High of 78 today, beautiful sunshine. I'm happy. I'm very happy.
I stayed up last night. I watched the Caps play their best game yet. They actually won rather easily last night, 4-1 over Columbus, tied up the series. Now we head back to Washington to see if we can lose another home game.
I think you guys are looking a lot better, so we'll have to see. I mean, at least you still have your team in. I've got to move over to the Vegas Knights now. I have to root for them. But in all honesty, I did not watch any hockey last night just because I was on it. I'm still kind of devastated that my guys got beat. Ducks, poor Ducks.
Yeah, there's always next year. Of course, that's been my slogan with the Caps since about the mid-1970s.
Yeah.
We just keep saying the same thing over and over again. The problem with the Caps is even if they somehow come back and win the series, which would be great after being down 2-0, losing 2 home games to start the series, next up is Pittsburgh, and that is our nemesis. We just –
yes.
If we've beaten them in the playoffs, I don't remember it.
Yes. They are really good. What are you going to say? I mean, they've just been so consistent. 2 Stanley Cups in a row. I mean, that's just ridiculous.
Yep. And share. I was going to say the difference between the Penguins and the Caps. The Penguins have Sidney Crosby, who steps up in the playoffs, and the Caps have Ovechkin, who tends to decline in the playoffs. And that's been the difference over the years. But anyway, we got a lot to go over. We can pass on hockey. I know.
Yes.
Just get into this market, which is, trending a little bit lower today. So I'll let you go through the schedule and the agenda. We'll get things going.
Indeed. Let's do this. So next week we have Gaddis Rose. He's finally joining us on the program on Wednesday, the 25th. We're moving the workshop that I'm going to do to Thursday. I think I'm going to do it on moving averages. So if I think that's what I think I want to do it on. But if y'all have some suggestions for me, I'll put them in the queue. And then we have Friday, everything stock charts. So it'll be great to find out what other tips and tricks they have on the site that even you and I, Tom, don't always know. So we always learn something. And as far as today's agenda, we will be starting off with, of course, the technical news. But after that, Tom is going to do his workshop on trading breakouts versus consolidation. So that should be a really interesting set. And then we have the 10 and 10 to 1. And our first symbol will be Applied Materials, AMAT. And finally, we will finish up with my sentiment update. And with that, Tom, I know we have a lot to cover, so let's hop to it.
All right, here we go. We've got the 10-year Treasury yield on the screen, as we always like to start here, see what's going on with the bond market. There was no economic news out this morning of significance. And so the bond market is left to kind of trade technically and just on everything, the earnings and everything that's going on around us. And 10-year Treasury yield continuing to move higher. It's been a strong month of April for the yield. We were down at in the low 270s to open the month, and we are now just 2/3 of the way through the month, and we're all the way back up near the high that was established in February at that 294 area, currently at 2.93%. And this carries a lot of significance in terms of how sectors perform. If we get a breakout on the 10-year Treasury yield, that tends to be extremely bullish for financials, and I would even throw in the industrials as well. We saw with rising Treasury yields, both of those sectors lead for long periods of time in this bull market. So I think it's important off of an uptrend and consolidating for a couple of months. If we see this breakout, just keep in mind that financials and industrials are likely to garner a lot of attention going forward. Want to mention today, Apple is really struggling. They will be reporting their earnings coming up next week, but you can see the last 2 days have been very weak for Apple. Volume has picked up. Today's volume is particularly heavy at 36.5 million shares, but do keep in mind that it is option expiration Friday, and we do tend to see higher volumes on option expiration day. I would really be paying attention to the support level right around 165 that I mentioned at the top of the show. If we break down below 165, it could simply be setting up some accumulation as we head into earnings next week. But technically, a loss of 165 could signal a move perhaps back down closer to 155 to that early February low. And that would not be a good thing for the market. Instead, what I think will probably happen is maybe we'll go back down and have an intraday break, and I would be looking for that. A false breakdown and a hold of support around 165 could signal a nice turnaround heading into Apple's earnings next week. We shall see. One thing I wanted to mention on, and I'm going to go into my blog article. Let's go in to yesterday's article first, because I did mention the historical tendency. I'm going to go down to the tendencies area in my blog. But I did want to mention that the 19th and the 20th of the calendar month, and for me, I believe it's because that it tends to coincide with options expiration, either the week of options expiration or the couple of days following the Monday and Tuesday or whatever that follows options expiration. That's when the 19th and 20th tends to fall. And I had posted yesterday that on the S&P 500, these 2 days carry pretty negative consequences for U.S. equities. On the S&P since 1950, you can see these annualized returns, which are not very good, especially when you consider that the S&P 500 normally moves up about 9% a year. So if all things were equal, we should be seeing the 19th and the 20th with annualized returns of 9%. You can see that we're way below that. And check out the Nasdaq since 1971. The numbers are even worse for these 2 days. So the 19th and 20th typically does carry some downside action. And I just wanted to mention that it was in the blog yesterday. So you shouldn't be shocked anytime the 19th and 20th rolls around and we do see some selling taking place. Now, what does that mean for the market? Because I think we need to take a look at the major indices. And yes, okay, maybe the 19th and 20th, it's typical to sell, but what should we be looking for technically? Well, the S&P has had a lot of either support or resistance these past couple of months between 2650, where you can see the low in early March. And then after we broke below that low in the latter part of March, the attempted rallies stalled at about 2675. So this 2650 to 2675 area, I think, is fairly significant. We broke above it. We've got the 20-day moving average starting to move higher. The weakness yesterday and today could simply be a test of the rising 20-day moving average in an otherwise uptrending market. Now, what would really look bullish would be for this rising 20-day moving average to hold and for another push to the upside to clear gap resistance. I think it was probably earlier this week, I had mentioned a couple of different levels to watch on the S&P 500 as we rallied. And if you connect these tops coming across here, it comes in at about 27.30. And then gap resistance was, I don't know, somewhere around 27.15 or so. And actually, there was a gap resistance zone, the top of the gap and the bottom of the gap. And then, of course, the moving averages, throw all that in. So there were a lot of reasons for sellers to come into the market toward the tail end of this week. And that's exactly what we've seen, in addition to the historical weakness that we tend to see on the 19th and 20th. But if we could hold the 20 and move back through these levels, I think that would be very bullish, especially if accompanied by a bullish centerline crossover on the PPO. So those are a couple things to watch. And I'm also going to pull up the Nasdaq, and you can see something very similar. The reaction high and the gap resistance all up in here, 72, 75 to maybe about 73.50. We got into that range, and the 19th and the 20th took over. We've seen some selling, but after we broke above the 20-day moving average just about a week and a half ago, you can see we came back down, held that 20, and then bounced off of it. That's what we want to see. Also, the PPO on the Nasdaq also sitting almost right on that center line. So this is a key area, pivotal area for the major indices. Let's take a look at the couple of the sectors here. The XLK, and I'm going to pull up this one because of all the major indices, with today's weakness in technology, this is the one that's currently sitting below its moving averages. Now, it may bounce off of it. I think it would be very bullish to make a move back toward the highs of the day later this afternoon and to see a reversal in Apple. But we need to see it first. We can't assume that's going to happen. If we stay where we are or we get weaker this afternoon, clearly that would be a negative for the bulls with technology breaking back down. But if you look at some of the other areas, let's take a look at consumer discretionary. We're still above both moving averages. The 20 is starting to converge on the 50-day moving average. And this one has moved slightly above the PPO center line. So the XLY looks pretty good. I mentioned financials and industrials could benefit from higher treasury yields. Financials still with some work to do to try and get above, I'm going to say around 28.35. That would be the bottom of gap resistance. Reaction high 28.25 and the 50-day moving average all at 28.20. But if the treasury yields continue to move higher and break out, I think it's just a matter of time before you see the XLF breaking above these key resistance areas. And then finally, the industrials, the XLI, also had broken above its 20-day moving average, has not yet tested it, and also trying to make this bullish cross. You can see that that kind of failed on both the attempts in late February and the second week of March when we saw strength in the S&P, and here we are again. So it would start to give the market much more of a bullish feel if we did continue higher and we got these breakouts on the PPO through centerline resistance. So that's going to be something really to watch closely. Wanted to mention just a couple of earnings reports, but before I do that, I did want to go back into the blogs page and just show you that Julius, he was on yesterday, and he promised that he was going to be posting a blog article, All Eyes on the Cat. It just got posted shortly, less than an hour ago. So for those of you that were waiting for that, just wanted to point out that Julius has posted that. And Julius's blog, Aaron's blogs, my blog, all of these different blogs, if you go to the bottom, you can subscribe. And the beauty there, that's a long article. Way to go, Julius. But the beauty here is if you type in your email address and click this subscribe button, you don't have to sit back and wait for the next blog article. They'll automatically be sent to the email address that you provide. You won't be spammed. I think it's a great feature at Stock Charts to keep up with, maybe Julius's style is the one that you follow. Maybe it's Aaron's and Decision Point. Maybe it's mine, Greg Schnell, whoever. The point is, if there's somebody that you really want to follow closely, I would strongly suggest that you move to their blog, go to the bottom, and subscribe to it. I know for me, I really, that's one way I know that I'm reaching out and actually, touching everybody that they are interested in my work, in that they subscribe. And I'm sure Aaron and everyone else feels the same way. So please do subscribe and show your support for our blogs. Just a couple of quick earnings reports, and I'm going to turn it over to Aaron for the upgrades and downgrades today. I wanted to mention GE because I talked about this at the opening. GE gapped above. I have to tell you that the volume trends have started to turn more bullish for GE. You can see the PPO is strengthening again. We have broken above both moving averages. The question's going to be, do we hold that rising 20-day moving average as we pull back? If we do, that could establish a reverse right shoulder. Here's a left shoulder, neckline, head, today's high, back up to test this area. This could be the neckline. A test of the 20 could be the bottoming right shoulder, and then a breakout above 15, 15 and a quarter, I think would be very bullish for GE. So I'm not quite there yet, but I do see, they beat their earnings this morning. They beat top line, bottom line. I think they held their guidance steady. And so that's all a positive for a company that's been so weak for so long. The other one I wanted to mention, not so good, was Manpower, MAN. Look at the reaction here. It had been struggling since the late January high. And today with its earnings, they did beat on top and bottom line. I didn't see any more, so I don't know if they lowered guidance going forward, but it certainly appears that they said something that the market didn't like, because it looks like we opened fairly flat, but there has been a huge sell-off since. So maybe it's their conference call. I don't know. But with that, I'll turn it over to Aaron for upgrades and downgrades.
All right, let's get to that. We have 4 upgrades and 1 downgrade that you handed me this morning, Tom. Some interesting charts there. I'm going to start with the downgrade, Procter & Gamble. And of course, this is in the consumer staples area. And it's not a surprise to see the downgrade after yesterday's gap down. So it's certainly struggling here. Do not like this, broken support here, area here. Look at the PMO is below the 0 line, giving us a sell signal. Certainly volume the OBV volume doesn't look good. I mean, you can see the selling that occurred on this gap down yesterday. It was pretty serious. Scooter is also dying. So we like to look at downgrades to see if we can find some opportunity here, but I'm certainly not seeing it when I look at Procter & Gamble. I decided I wanted to look at a weekly chart just for grins, and you could see it has just been struggling. And as far as the market, when we were rallying, staples were one of the better sectors, or as we were coming down. But right now you can see, as far as Procter & Gamble, not looking good at all. I'm looking at this 75 area right here, where we had these tops, and this top back in 2013, and we are below that with today's trading. So I beware of Procter & Gamble, and I certainly wouldn't be looking to catch that particular falling knife, as they say. Let's look at a couple of upgrades. Align Technologies. Even on the upgrade, I do see a PMO that is topped, and it is heading for a sell signal. But when I look at price action, I'm not overly concerned about that. You have a rising bottoms trend line. It looks pretty good here. We're getting ready to come down and test it. We avoided, it looks like we got the intermediate term trend model neutral signal, but it immediately whipsawed back into a buy signal. This is a pretty deep decline here on the last 2 days of trading, but watch this rising bottoms trend line. If we can hold some support here, that might be worth grabbing on a bottom, especially after getting an upgrade. So I think there's some good chances there on that one. Darden Restaurants, you can see a big gap down back in March. It's managed to round up here. It's in the process of trying to close that gap. So we'll be watching this area here just above 92 very closely. We have the buy signal, OBV, Scooter, everything's looking very healthy right now. But after a very long rally like this, not a surprise to see. This is going to be the area of the real test, rubber meets the road, that sort of thing. So we'll be watching that 92 level very closely. That's where I would look for a possible downturn, maybe pull back at that point. But you can see the price action's been pretty good. It'll go and rise and then consolidate, rise and consolidate with little tiny flags all the way up. Tractor Supply, excuse me, been in a trading zone here. Looked like it was going to pop above that zone earlier today, but we've come way back down. You can see we're trading at near the lows on the day. The volume is not looking good here. When you look at the OBV volume, you've got down declining tops, and you also can see the volume drying up here, interest on tractor supply drying up a bit. But I don't like that it hit that overhead resistance and is pulling back down. We do have the upgrade. We are seeing the PMO trying to move upward. Might be worth a watch here, but the fact that it hasn't been able to break out in a while certainly makes it less interesting to me. All right, and Twitter, let's finish up with that, and then I'll get right to you, Tom. Got a new PMO buy signal recently. Look at the healthy scooter. OBV volume's pretty flat. I don't mind that. I can forgive that. And again, you've got that whipsaw into the buy signal. And we're getting ready to hit some overhead resistance, but I think that the major area, of course, is going to be at the highs we saw in March. And it looks like it's ready to head that direction. Like I said, PMO now above zero, looking pretty good here. And that is it for the upgrades and downgrades. So I will pass it back to you, Tom. It's time for your wonderful workshop. Can't wait.
All right, appreciate it. Yeah, I'm looking forward to it as well. Of course, I do a lot more of consolidation trading than I do breakouts, but maybe I can help provide some information on both. And some of you may be more inclined to trade breakouts, and some others may like the pullback style that I use, but I'll try to give you some information on both. So let me start off, grab the screen, and just kind of walk you through a little bit of what I think about in terms of these breakouts. So you should have the chart of Whiting Petroleum, WLL, up on your screen now. And actually, I think I've annotated this. So let me move over here. Yeah, here we go. Okay, so first of all, a breakout. I don't want to take anything for granted here, but a breakout is when price action is moving above a prior high. It could be a high from back in January. It could be a high back in November. It could be a high from back in 2014. It's just a breakout is taking out a prior high. Now, others might look at breakouts as maybe, and I guess I would include myself in this as well. It can be a breakout of a pattern. Doesn't necessarily have to be taking out a prior price high. So, for instance, if we were looking at Whiting, I didn't annotate this, but if you look at this downtrend, you got a little channel going for a while. Clearly, this candle here, as you move back up, has broken out of this downtrend. The sideways action kind of broke out of it, but certainly that heavy volume move there, that I would consider to be a breakout of just a period of price declining. Same holds true over here in November, where we were declining, and then we sideways consolidate, and all of a sudden volume comes in, and we make a little bit of a breakout above that prior high and that downtrend. So you've got to keep in mind that there are multiple breakout types. And as far as trading them, I guess it would depend a little bit on how comfortable you are with each type of breakout. Some refer to a breakout like this above the moving averages. I'm not as much in that camp. I think a lot of times when you're consolidating like we were here, you'll see these moves above and below. I don't want to call this a breakout, this a breakdown, this a breakout, this a breakdown, I mean, to me, it's just sideways consolidation. I don't really see breakouts, but there are many who do look at it. I find a move through the moving averages and price resistance to be doubly bullish. Anytime you can line up more than one indicator, I think that's a good thing. So with Whiting, though, and all of these stocks that I'm going to be giving you on the breakout part of this workshop came from yesterday's 52-week highs. So you can see yesterday it was putting in a new high. That is, even though my charts only goes back 6 months, it is a 52-week high. So, you know, when you think of a stock hitting a 52-week high, I automatically think of a breakout. But if I looked at this chart yesterday and I saw it moving above the prior high, I would not necessarily be interested in buying it. And the reason being, I always want to manage how much risk I'm taking relative to how much reward I think I can get out of the stock. Now, in this particular case, after it had gone sideways here, it looks like maybe sideways consolidation, $3, it makes the breakout. If you had caught the breakout here at, say, I guess that would have been April 10th, the volume did pick up. It confirmed If this was the breakout you were planning, you might be able to set a target and say, well, it just consolidated in a $3 range. I'll be looking for a $3 move from 35. If it gets to 38, I'll take it. If it closes back below 35, I'll get out. That, to me, would set up a solid reward to risk trade. But yesterday, it's making a 52-week high. And when I look at the chart, I'm looking at a stock now that has an RSI at 74. You can see that the PPO is pretty stretched. Anytime you get a PPO up around 6 2/3%, that's telling you that it's been moving pretty solid. And you go back to February low of $22, and here we are up near 40. This stock's gone quite a ways, and just a normal pullback to the rising 20-day moving average, which we've seen multiple times during this uptrend, would present quite a bit of risk. Right now, the 20-day is sitting at $36, just below $36. We'd be looking at a 10% decline just to have a normal test of a rising 20-day moving average. So in order to justify this trade, I would want to see at least a 2-to-1 reward to risk ratio. So if I'm willing to take 10% to the downside, that means I better figure out a way to look for 20% upside move or more. And there's just no way, looking at this chart, that I can project that. So I would look at this and say, yeah, I really like this chart. It looks bullish. It's been behaving bullishly. It's in a nice space in the market now, but it's not at a level that I would buy, even though it is in breakout territory, because I want to get it on a pullback. And that brings up a whole different concept. You can play breakouts if you catch the breakout, but the second entry a lot of times is when it goes back and tests that breakout area. There's a lot that's been written at stock charts, and a lot of the technicians refer to broken resistance becomes support. That's kind of technical analysis 101. So when you break above a key area of resistance, a lot of times you'll come back down and you'll test that support level and then move higher. The beauty of that is that when it comes back down and tests your support, now all of a sudden you can get into a trade with fairly limited risk because you're expecting it to come down, test, and then bounce. Even a test of the 20-day moving average at this point, if I got in at 36, I'd be looking for another move back up to 40, which would be $4. I could put a stop in of about $1 to the downside because this is my price support level. So now all of a sudden I've got a 4-to-1 reward to risk ratio. So when I look at breakouts, that's how I try to evaluate it. I have to be able to set it up so that I can hopefully collect more on the reward than I would be risking to the downside if the trade falls apart on me. And they will fall apart. There's nothing. I mean, it could just be the fact that the market gets weak. It could be the fact that a particular sector or industry group that you're in sees money rotate away from it. Your stock may be perfectly fine, but it may just simply lose support because there's money rotating out of the group. I expect it to hold support. Many times it will, but I've seen plenty of support levels fail to hold. And so as a result, I mean, this would be a perfect example here. You've got this area right in here at about $28, $28.50. You break above, you come back down, you test it, you bounce, you think you got a winner, and then it falls apart. So you have to be prepared to step away from this trade. Otherwise, this would have been this would have been very painful over about 2 weeks to get into a stock around 28 and 2 weeks later be down 21 and change and trying to decide whether to hold as it threatens a multi-month breakdown. That's where all the emotions come into a trade. So a lot of different scenarios here on whiting on this chart. And I just wanted to point some of those out, how, at least when I'm looking at a chart, how I try to set up a potential trade. I do have a couple of others that I have annotated. I don't have all my charts annotated, but I do have a couple others. Here's Grainger, WW Grainger. First of all, this has been a great performer. This is a company that has produced excellent quarterly earnings the last 2 quarters. We saw it back in January with the huge move up on heavy volume. Notice it comes back down and consolidates. It was very overbought, but at one point it dipped into the 40s on the RSI, printed a hammer on the 50-day moving average near support. So I guess my question would be, if you're trading a stock like this, do you want to do it after it's gone up 2 straight days with an RSI at 80, knowing that you could get a 20-day test and be very painful? Or would you rather a stock consolidate over 5-6 weeks, pull back, RSI drops into the 40s, we print a nice little hammer on the 50-day moving average near gap, in gap support, near a prior support level. Now you get into a stock like this at 250, and you're looking at the prior high near 300 and you're calculating, okay, that's a potential, really nice potential gain on Grainger. Whereas to the downside, maybe I give it this low, maybe I give it the prior price resistance, which is then support. I mean, even that's down around, 240-ish. So maybe I have $10 or $15 of room to the downside that I give it, but I've got $45 back to the upside. So again, you've got a much stronger reward to risk if you allow the stock to come back. Now, it's hard to get past your mind sometimes because, your mind definitely plays tricks with you. And when a stock is coming down, I took a course long time ago. It's probably about 12 or 13 years ago. It was one of the best courses I took, though, and it dealt with the psychology of trading and the fact that humans, it's their nature to want to be part of the crowd. Whatever everybody else is doing, we kind of want to do that. That seems right. So with trading, a lot of times you get stocks that are moving higher and you watch it go up 8-10 days in a row and you're like, wow, this is the kind of stock I want to be in. So you jump in. And then when it starts moving down 4 or 5 days in a row, you can't take the pain anymore and you get out. You're in a perfectly good stock, but you pick the wrong time to get in and you pick the wrong time to get out because the human emotion starts taking over. So you really have to pay attention to that and monitor your reward to risk when you're entering. And I always say, you got to know why you're getting in, what it's going to take to get you out. In other words, where your stop's going to be and what your target is. And you should evaluate that trade every day at a minimum. Now, I'm more of a daily or, short-term trader. So I'm going to hold stocks. I mean, if they don't work out for me, I could be out of the stock same day I get in because a lot of times I'm getting in near support. And if a stock doesn't hold that support, I could get right back out and take a small loss. So those are some of the things that you need to be thinking about. But GWW here has got a beautiful uptrend. You can see the consolidation, these equal highs. It did break out here yesterday with a very solid earnings report. But look at that black candle. It tells me that even though it gapped up and there was a lot of demand at the open, it did get to 310 earlier in the session. It came back down and closed at 300. So there were sellers out there. Many times you'll see the gap fill, maybe a 20-day test, maybe another trend line test. I think as WW Grainger drops here and gets down closer to about 284, 285, I think things start to turn very solidly in favor of being long this particular stock. The next stock up is AYX. Now, when I'm looking at stocks, I also want to be aware of what's going on with the PPO because that's telling me whether or not I have momentum issues. And so I could look back here at AYX, for instance, back in November and December, and you see how we put in the higher highs and check out the PPO. You got a much lower PPO reading. So many times you'll see an extended period of consolidation, sometimes outright selling. And that's exactly what we saw here. Big selling, went all the way back down, hit the 50-day moving average. The PPO worked its way back to center line support, and then the stock became a pretty good trade. So you want to be careful if you're jumping in on a breakout if you have a negative divergence, because that's what we had here. So if you get a breakout above these prior highs and you fail to hold the breakout, to me, that's a big warning sign. Now, in this case, we worked our way all the way back to the center line, and we're starting to strengthen again with this move. But check this out. Now, if I bought this stock on the breakout yesterday, if I had bought it because I saw it was breaking to a 52-week high and it was taking out this prior high, I would get out if it failed to hold that on the close, because I would be thinking it's going to go all the way back down to the 20-day. And if it's going to go back down to the 20-day, I don't want to be holding it as it does that. To me, it's just tying up capital. Maybe some of you, it's too active trading and you're not interested, and that's fine if that doesn't fit your style. But for me, I do watch the market all the time, and I don't really enjoy getting into a stock that reverses and then watch it go down for the next 2 or 3 days. What I would rather do is get out, and if I still like the stock, when it goes down over the next 2 or 3 days, get back in when it hits the 20-day moving average and save that pain on the reversal. So this one is a breakout, but it was a false breakout, and these can be really painful if you're a breakout trader. You got to be able to recognize that that was not a good candle, and don't take the chance of it going lower. And I don't know if it's going to go down to that 20-day moving average or not, but I've seen enough charts to realize that there's a good chance that it's going back down there. So I don't want to hold, I wouldn't want to hold that. And I do think a lot of times the breakouts, there's so many different factors to consider. I think you can get a lot of whipsaw with breakouts. And again, I've traded breakouts a lot over the years, and I did not find it to be nearly as successful for me as trading consolidation. And I'll get into consolidation in just a minute. Let's take a look at a couple more of these charts, though. NSP, big breakout here. And actually, I should have moved this arrow over one more candle, because here's the sideways consolidation. I think one of the things that's most important to me on a breakout is I don't want to get a stock that's broken out and has been trading higher 6-7 straight days. To me, you're going to get an overbought situation where RSI moves into, up to 70 or above 70, and then you're just going to run into some difficulties if we start to pull back, because you're going to have so much room between current price and that rising 20-day moving average that it's going to become painful just on a normal pullback holding a stock. So I don't like to buy it. I don't like to chase a rally. Now, this candle right here, which was on April 13th, was actually breaking out, and there was some decent volume. Now, overall, I would like to see a little bit more volume on my stocks than this one has, but you definitely can see that the volume picked up on this move to the upside. I think that's bullish. I want to know that there's some accumulation taking place on a move to the upside. If it's very light volume, I'm going to be afraid it's manipulation. So here we made the breakout. Now, if I bought it on that close, I would be looking for sideways consolidation, roughly of about $5. I could look for a measurement of $5 up to about 77.5, which we have since reached. So literally a stock like this, I could have owned it 3 or 4 days and been out of it, got my $5 and moved to the sidelines because I hit my measurement. And you might say, well, why? Maybe it'll go up another $5. Well, the problem is I don't know exactly how much further. I don't have a measurement that takes me up any further. And what if it just pulls back to 72.50? Am I just going to give away that profit and wait and then see if it comes back up? To me, it did exactly what I wanted it to do. If I was getting in and I calculated a target of 77.50 and it hits it, why wouldn't I take it? So again, it's a timing thing. If I don't catch this move when it's first making the breakout, I would let it go and wait until I can get a better reward to risk entry. Because again, here, what I'm looking at is as it's making this breakout, look at the PPO. See how we had a negative divergence? So it's breaking out on heavy volume, so I'm okay trading that. But if it fails to hold the breakout, I'm going to get out. So I'm able to keep a tight stop. But I can't do that if I wait and buy it 4 or 5 days later. HES, H-E-S, I think I just have a couple more here on the consolidation. But here's a beautiful breakout. PPO looks good. Volume's picking up. Again, if I get it on this breakout, I could hold it so long as it doesn't close back below that support level, which this one didn't, and it continued moving higher. One of the problems, though, is that as it made the breakout, you can see we are a little bit, or at least we're approaching overbought. And I really don't know where to set the target looking at this chart. Now, maybe if I went to a longer-term chart, I could find a resistance area. But if this happened to be an all-time high breakout, which I know it wasn't on HES, but if it was, the problem is, where do I set a target? So sometimes if I don't know where to set a target, it's really difficult to trade because I don't know what it's going to take for me to take profit. So I'm going to start allowing emotions to creep into that trade. RIG, this is, oops, I thought I had one more that I had highlighted. Well, let's pull up RIG because I did have that as another breakout candidate. And here you can see, here's your breakout. PPO looks great. The breakout was clearing this prior high of 12.25. We went below intraday, but now we're starting to come back up. If I got into this breakout, number one, I would probably be hard pressed because the RSI, you can see just a couple of days ago when it broke out, was probably in the mid to upper 70s. So I typically don't jump in then. We've had a huge run. What happens if we just make a quick pullback to the 20-day? I'm going to be down 10% on my trade and still not hitting a stop area. I don't want to be down 10% before I'm ready to pull the trigger on the sell. I want to make 10% to the upside, but I'd like to keep my stop to maybe 2 or 3%. So this one would not have worked out for me, even though the chart looks great. It's one that I certainly would keep on a watch list. And then the last one I wanted to mention here, INXN. I think that this is a pretty interesting opportunity because if you look, I'm going to pull up the weekly chart. I think what you got is a beautiful uptrend, and this cup that we just saw on the daily chart. Let me go back. See here, you think, well, that might not be a cup because it's kind of erasing most of this uptrend. That's why you want to go to look at a weekly chart. And on a weekly chart, you can see we had a very long uptrend. This is a nice little cup, sideways consolidation, putting in the handle, and now we're breaking out. And look at the volume picking up on this move. This actually measures up to about 73 to 74. So on this breakout, I have a measurement of 73, 74. To the downside, I've got price support and that rising 20-day moving average around 63. So even at the current price, I could maybe make a little bit of a case for it, although I'd really like to see a pullback back into 63s. Then my reward to risk gets even better, and I can keep that stop much tighter. So that's kind of the way I look at breakouts. There's, as I mentioned, there's a number of different ways to play breakouts, but these are some of the more common for me. I do want to make sure volume confirms on the moves to the upside to breakout. I want to make sure that there's accumulation. To me, it just gives me a little bit more comfort that market makers are likely building an inventory on the move to the upside, and that usually is a sign of accumulation. The other things to keep in mind, when you're breaking out, to these new highs, but you've got your RSI above 70, just a normal 20-day test. I mean, it looked great on the first day of February. 2 days later, that would have been painful, down $3 or $4. Again, I think you're just taking too much risk when you chase these moves to the upside. And then finally, if you miss the initial breakout, a lot of times you can catch that on the way back. You can hit price support. Now, consolidation for me, my preference is to trade where I can maximize my reward and minimize my risk. And I always try to establish my price target, my strategy. Am I going to buy at one level? Am I going to buy at a couple levels? And also I want to consider where I'm going to put a stop before I ever buy the stock. So I'm going to bring you up a couple of, and I want to go over a little bit of the trading results at earningsbeats.com, because really what I do, I mean, I help John Hopkins at Earnings Beats create their trading strategy using only companies that have beaten top and bottom lines. That gives me a little bit of fundamental comfort about the companies. And then when they come back to a key support level, it just gives me a little bit more of confidence in placing that trade. So I'm going to pull up a couple of these trades. And these are trades. I didn't go back into my own personal trades, although I think I did have one or two of these. But these were trades that Earnings Beats had out. And just to give you an idea or sense of how trading in consolidation can work and how they can benefit you. I know that I did a webinar with John Hopkins recently and went over the earningsbeats.com performance results. And just to give you an idea, back in the second quarter of 2017, Earnings Beats had 5 winners and 6 losers, only had 11 trades out. But the average gain was 6.49%. The average loss was 3%. So better than 2-to-1 ratio. In the third quarter, there were 10 winners and 6 losers, but the average per winner was 8.1%, and the average per loser was 1.64%. And then in the fourth quarter, they really stepped up their trading candidates, but there were 21 winners and 18 losers. And the average gain was 6.19%. The average loss was 2.28%. And I mention this because I think it's really important to admit sometimes that what you think is going to happen in a trade doesn't happen. And when I went back and added up those winners and losers in 2017 for those last 3 quarters, Earnings Beats had 36 winners and 30 losers. And the market had a really good year. And you might look at that and say, wow, 36 and 30, that's not very good. But the key is in the returns per winner and the returns per loser. Having your stops tight takes you out of big risk to the downside, and then having targets 2 or 3 or even 4 times higher obviously is going to create a lot more potential return. Now, when that 2017 result came out in those 3 quarters, I think that the total that was used, because earnings beats never had out more than 7 trades at any one time, I think because John had asked me to calculate their risk-adjusted return, and I went back and did that for him. And so I used a $70,000 make-believe portfolio. And I used $70,000 because I assumed $10,000 per trade. And there were never more than 7 trades out at one time. So I knew that there would never be any margin interest or anything like that. But what I found is that if you had just invested that full $70,000 into the S&P 500, that over those 9 months, you would have made, actually made $8,855, which would have represented, I don't know, probably about a 12%, 12.5% return. Earnings beats on those actual trades that were put out there showed a profit of $16,438, which was almost double what you would have had in the just investing in the spider. Now, the real trick here is only 40% of the account balance was invested throughout those 9 months. So you're taking 60% of the risk out and you're doubling your return. Now, I'm not saying you're going to get those kinds of returns, but that's the whole idea. And that was the concept that we, that was born at Earnings Beats back in 2013 when I worked with John. And so I think that this is a system that works. It's worked through different types of markets. It worked through the 2015, 2016 corrections. It's worked in the moves to the upside. It's worked in downside moves. And the bottom line is, number one, when the volatility index is rising, you want to trade less because you're going to get whipsawed. You're going to take some rather quick hits. And sometimes if you don't use intraday stops, you're probably going to take some really large hits, as we saw over the past couple of months. But, it's really important to me to make sure that you do keep those stops in play and that you analyze the environment that you're in. I would much rather trade a market with a VIX of 10 than a VIX of 30. Some people really like that excitement and of waking up to futures that are up or down 500 points. To me, that is like, I need Pepto-Bismol. I can't even sleep wondering what's going to happen the next morning if I leave a bunch of money in the market. So I tend to move more into cash, and I rarely trade in these high volatility environments. But I want to go over just a few of these stocks, and then we'll wrap up, that Earnings Beats put out, and just kind of go over, I don't want to say their strategy, because it's also my strategy. I use the strong earnings chart list, and a couple of these stocks I did own. DO was one. I did own this stock, and I'm going to go back a little further. This is a 1-year chart, and you can see that we had a nice move higher. Energy stocks were doing much better, and Diamond Offshore was having this nice move. Earnings Beats actually put this stock out on November 27th at $15.38. And I was looking at it on the chart. And of course, you had been moving higher. The PPO was weakening. So you're looking for a 50-day test. This stock came right down on the 27th, tested its 50-day, tested price support. And I'm not sure. I didn't go back in and look to see what the stop was. My guess is it was probably a close below the 50-day moving average. Target, I would have thought, was back up near 17.5. But I did see that the exit was on December 12th, right here, and the price was $16.97. So it was a $1.59 winner. So a little bit more than 10% in 15 days, something like that. And then you're back on the sideline and there's no more, you're not at risk. Now you might say, well, boy, you could have made a lot more money. Well, yeah. And if you were a perfect timer, that would have been awesome. But what if you continue to hold and then all of a sudden you watch this entry point of 15.38 become 13 and change? And now instead of having a 10% winner or 20% winner, now you have a 10% loser. That's what happens in the market to most companies. Not every company like Netflix and Amazon and Apple go up years and years and years, just keep going higher. They go through cycles. They look good for a while, they break down, then they start to look good again, then they break down. It's just, not every chart has a beautiful move from the left lower corner to the right upper corner, where it just continually rises. Many of them do exactly what Diamond Offshore did here. A second chart. I'm going to give you a couple winners, and I'm going to give you a couple losers to show you the difference. Here, PetSmart had come out with great earnings, huge gap up, but look at that shooting star candle. That normally tells you you're going to see some weakness, and saw weakness. Came all the way back down, and I think it was here. October 31st, bought at 34.82. So you got these other support levels in here, and 34.82 is the entry, sold at 38.96. So we're able to, and that was on November 15th. So, and it continued moving higher, and then again came back down. The point is, you got down to a level where you could keep a fairly tight stop with a lot of upside potential. And I don't even know why the sell here. I mean, John was pulling the trigger here. Maybe he didn't like that candle, or maybe it was maybe just because, you know, he's up 10% in 2 weeks. I'm not sure. But anyway, again, managing your risk to the downside, very important. NVIDIA. This one at Earnings Beats was bought on 925 right here. And I could see this one. Beautiful move up, very heavy volume, pulls all the way back down. And by the way, when it moved up, look at the RSI up in the 70s. When it pulls back down and hits gap support and price support, the RSI dips below 50. Now I can manage my risk. Maybe it's the 50-day moving average. Maybe it's gap support. Maybe it's the combination of both. But now I can be looking at a fairly tight stop with a return, or at least hoping that I'm going to get a return back up to 190. Earnings Beats actually triggered a sell on October 10th at 193. It was probably on this gap up. I'm guessing that they probably had a target of 190 and it gapped up above it, and they just got out. So again, NVIDIA went up, but then a couple weeks later, it was back into the 170s, 180s. So you're going to hold and just tie up your capital, or are you going to take these quick trades? Again, it comes down to individual preferences. 2 stocks I want to show just on consolidation. These did not work out. And this is why I think it's important to have a stop in play. SCVL, it was bought on December 8th. Now, here was the gap up with earnings, huge move up, very, very overbought conditions. But check out December 8th right in here, coming back down near that 20-day moving average. And look at the RSI, which in this case was back down around 50 or in the 50s, much better than 85. But ended up getting stopped out on December 15th at 24.83. So this was a stock that was held a week, lost 20 cents on a $25 entry. So a 1% loser. And I'm looking at this trying to figure out, I'm guessing that maybe the stop was a close below the 20-day. It looks like it may have closed just below the 20-day on the 15th. Now, again, you might say with hindsight, well, you should have held, you could have gotten it back up 27. And obviously, if you knew that ahead of time, you would have done that. But who's to say you don't continue holding until it gets all the way back down to 21? Point is, I think what John had done here is he had figured out, okay, I'm going to hold it as long as it closes above the 20-day moving average. It didn't, and he took the loss. And then the last one, I know this one, I thought this was a perfect setup, and I owned it, and I know I ended up taking a loss on it. GII, Apparel Group. And on this particular stock, here was the gap up. Look at this sideways consolidation for months. Beautiful gap up, great volume, looks perfect. Comes back down, and I remember that candle. Earnings Beats got in on 921. I don't remember if I was in on 920 or 921, but basically it was at the same time. Pulled back, had the rising 20-day moving average, had gap support, price support. I mean, this was a thing of beauty, and I remember talking about it quite a bit here on the show. We got a nice move up, bounced off of it, but never got to the target. Didn't take profits, and it came back down, and Earnings Beats ended up selling at 26.61, which was probably about a 5% loser. One of their biggest ones. I think that's why I picked this one. But it came down, and it was probably a stop below the moving average, a close below the moving average. And it probably closed. This was October 12th. So 10th, 11th. Must have been this one. I'm not sure where the stop was. But the point is, it didn't work out. It looked good. The setup was perfect, but it didn't look good. And if you had held, moved back up, hit the 20, and went down again all the way to $23. So you're able to get out of 26. Now, again, you might use hindsight and say, yeah, but you could have gotten out at 40. well, I could make a lot of money if I could go in and just, look at what the stock did 4 months later and be able to trade off of that. That'd be perfect, but that's not reality. Reality is you have to make those decisions in real time, and they're not nearly as easy as looking back on a chart and seeing where everything ended up. So anyhow, for me, that's the difference. Breakouts, I think, can be solid trade candidates, but there are a lot of factors that go into it. Depending on if you're breaking out with a negative divergence, if you're breaking out with light volume, if you're breaking out, but you've been breaking out for the last 10 days in a row and you're very stretched, there's a lot. Just be careful with those breakouts. And if you miss a breakout, don't chase it, because a lot of times they'll come back to you and you'll be able to get back in at support. And then on the consolidation side, again, this is my favorite. I love to trade gaps. Like this gap, this was an earnings related gap on GIII, and came all the way back down exactly where I wanted to get in. Had great reward to risk in mind on this one. Figured I could probably get about $3 to the upside, which would have been, I don't know, maybe 11, 12%. And to the downside, I don't remember where I got out of this. I may have gotten out on the candle where we broke down below the gap support, maybe in a little bit lower, I'm not sure. But the point is, you can keep your, if you manage your stops, you manage your risk, you can create a trading environment where your gains tend to be much higher than your losses are to the downside. It's not about being right 90% of the time. As I said, earnings beats was right 36 times, and they were wrong 30 times in 2017. So get that out of your head that you have to be right every time. The key really is in managing risk. And with that, I'm going to turn it back over to you, Aaron. I know I ran a little bit over, but we'll try to get back on track with the 10 and 10.
All righty. Yes, I've got them ready. I've closed it out, guys, so I can't take any more requests, but I am, go ahead and continue to like, because the second stock will be whatever was the most popular in the chat room this morning. So, but we are starting with Applied Materials, and I will just have you go do that. So since we're running just a little bit late.
Okay. All right, Applied Materials. Well, semiconductors got crushed yesterday, and Applied Materials was one of the stocks leading to the downside. We did get a little bit of a bounce to test overhead resistance, and now it appears we're moving lower again. It looks to me like Applied Materials could be heading back down toward this February lows. Maybe it turns before that, but it's really hard to tell exactly where it might turn, because I'm not seeing huge support levels going back. I mean, maybe there's one right about there, but you can see this low here, and then there's a little bit of jockeying back and forth in this range. So maybe somewhere in the 49s we'll see a reversal similar to what we've seen in the past. But yeah, this is not good action. Heavy volume breakdown. We went back up and tested this breakdown area, and then have started to move lower. So I'm a little bit cautious on Applied Materials short term. Longer term, I still love the company.
All right, let's see what our most popular request is in the chat room. It is Snap. Snap is the winner.
All right, Snap finally snapping back. This is a really good candle today so far. We'll see whether or not it can hold. And it's kind of following on the back of Twitter, which just a couple of days ago had a huge move up. And Twitter was upgraded earlier today, as I think you went over, Aaron. So nice move in this group. And I think, I don't know if it was yesterday or maybe it was earlier today when I was looking at it, but I believe the internet stocks are among the leaders in the technology space, maybe the best performing industry group today. But Snap is clearing a pretty important 20-day moving average, and it's trying to get back through this reaction high. So we came all the way back down. In my opinion, we held right where we needed to at gap support, printed this reversing, piercing candle. And today's action, I actually think, is really bullish. If we can close above, if we close near the high of the day, 1540, 1550 or higher, I would look for this to be start of maybe another run to the upside on Snap. I think this is one that could move into its next earnings report. It's been beaten down quite a bit of late. A lot of it was due to Facebook, but I'm starting to see some strength here.
All righty. Next one is Neovasc. It is NVCN. This one was the big outlier when I just ran my RRG, so I thought we would look at that.
Oh, wow. I mean, this is just not any, I mean, first of all, it's 5-cent stock.
Uh-oh, I didn't check that out. No wonder.
Yeah, this is just not something that I ever trade. And, I mean, there's some said, wow, it's a 50-cent stock. That means it's really cheap. Well, that was, two or 3 months ago, and it just lost 90% of its value. That's what always gets me when I hear someone say that it's really cheap. It's 50 cents, and therefore I can't lose much money. Well, yeah, you can. You can lose 100% of your investment. It doesn't matter whether the stock's 50 cents or 50,000. It's just, I know how much money I want to invest, and I don't care if I'm buying 2 shares of a stock or if I'm buying 20,000 shares of a stock. I'm still investing the same amount of money, and it can go higher and it can go lower. And so you still want to keep in mind where your risk, how much risk you want to take on a stock and so forth. But NVCN, I mean, looking at this, I don't know what's going on with the stock, but it just went down to literally about 1 or 2 pennies on massive volume. It's bounced back a little bit. It's drifting lower. This is just not my kind of stock. I'm not a penny stock player. Again, I'm trying to manage risk. This is a stock that's not on the regular exchanges. I think they present a lot more risk in trading. So I would just avoid it.
Okay. All right. The next one I have for you is Alibaba.
All right, now this one I think is continuing to consolidate sideways. I'm going to pull up the weekly chart to see if, because I'm pretty sure, yeah, we got a nice uptrend. Here's the problem with Alibaba: negative divergence on the weekly chart. And all that daily consolidation that we've been seeing a lot of times stems from the fact that a stock just moves too far, too fast. And here is the rising prices, and here is your lower PMO for a period of about 4 or 5 months. That to me is a sign of slowing momentum. Check out the reversing candle with a negative divergence with heavy volume. That is not good. I'd be looking for a 50 period moving average test and a PPO centerline test. And that is just about where we are right now. So when I get that negative divergence, that's what I'm looking for. And that's what we've got. And I actually think Alibaba from this point, the reward to risk looks much, much better.
Okay. Let's see the next one, CVX. I think you're familiar with that one.
Yeah, I think I've looked at that one once or twice before. I've got the weekly. Let's go back to the daily. Looks like we're in a nice breakout situation here. This is one I think Joyce was talking about yesterday that he liked, that was starting to strengthen, and I can see exactly what he was looking at. We had some gap resistance. You can see the huge gap down back in February. Look at all these failed attempts trying to get through 117, 117 and a half. Finally, we did that 2 weeks ago. Again, we just got up too far. RSI got to 70. So this is a breakout of sorts. And if you catch the breakout, you can play the trade. The problem is now we've topped. We're starting to pull back. I would be looking for that rising 20-day as possible entry.
All righty. Let's see the next one. How about Zillow? Z.
Let's see here. Z. Let's see, that was our 5th one, right? Yep, there we go. Okay, so number 6 is Z. Oh, well, it's been under a lot of selling pressure, but this is, is kind of following the big move we saw to the upside. I think I may have looked at this recently, and I kind of liked it as getting close to 48. But 48 and 46 are the 2 key areas. Actually, I think I kind of remember annotating both of these support levels. There was the resistance here for a while before we made this big breakout. And just before that occurred, you can see that we had made a breakout and had been trading in this 46, 48 range. I would be looking, what I would really like to see on Zillow is an intraday move below 46, maybe to 45, and come back up and print a really nice looking reversing candle. And then I think we'd have a shot maybe to get back up to 50, 51 to challenge this reaction high and that falling 20-day moving average.
All right, let's see. Next one, RHHBY, and that is Roche Holding. That's healthcare pharmaceuticals.
Yeah, I'm going to do this one in the relative chart because, again, when you're talking about the pharmas, any of these stocks in the pharma group, look at how weak they have been in 2018 since we set a relative high. And this was a head fake for me, by the way. I really thought that the pharmas were ready to take off back in January. I think I wrote about it. But you've got to be willing to back off and not stick with something, especially when it's looking like it's not going to work. And we had a relative breakout on the pharmas right here. You can see a nice relative break, or excuse me, an absolute breakout, went back and tested it and broke to a new high. That normally is pretty bullish, but of course, we ran into a lot of sellers at the end of January and early February. Many of the pharmas were crushed, and you could see the index dropping about 10% or more in maybe a week and a half or so. But this is a stock that, if you look at it, is just not a great performer. So even if you like the group, I think you got to be careful jumping into a stock that is looking like that relative to its peers. Then you look at it, if you're trying to outperform the S&P 500, really difficult to do it with this stock. And then this is the indication of the pharmas relative to the S&P 500, which they are very weak as well. So I'm just not seeing a whole lot here on the chart. There was support, pretty good support at about 28.5. That's been lost. We're currently closing at new lows. I'd have to be waiting on this one to see something technically that stands out. Right now, I don't see it.
All right. The next one is Trex, Trex.
All right, Trex.
Building materials.
All right, I'll do one more in the relative chart here. A lot of consolidation, so I do like that. If we do ultimately get a breakout, I am much more interested in a breakout where we've got multi-month consolidation after an uptrend. So there you can see Trex on the move up, very strong. I'm assuming that's earnings related back in late October. Sideways consolidation. This was probably an earnings here, but it held on to support and continues to consolidate between 103 and 118. I would play the trading range. So any kind of a move back down into, say, 103, 104 would start to get my attention because I can keep a really tight stop. And if I get that move back up to 116, 117, we're talking about, I don't know, maybe a 13% move or so. Looking at the rest of the chart, you can see the building materials not exactly on fire, but you do have a fairly strong stock within this space. So let's annotate this. Really starting back last year, huge move. And even with the consolidation in price, we're actually getting a little bit of a relative breakout. Or we did just recently get a little bit of a relative breakout. This is a stock that's performed very well relative to the S&P 500. But again, it's in a group that has not performed very well. So there are a lot of mixed signals here. I like the stock. And if we start to see relative strength in the group and we get a breakout here, I think it would be very bullish for Trex.
Okay. Next one, number 9, is Fossil, FOSL.
Yeah, this is one I'm kicking myself that I didn't hold longer. They came out with an unbelievably strong report back in the middle of February with that huge gap up. And when it came back down, I think I talked about this one possibly moving back down as low as 11-ish. Never quite got down there. And I had it. I ended up, I made money, so I'm not going to complain too much there. But that was the breakout area. This was the pullback. So 11 to 11.5 is key support. We did make the big move to the upside. We've pulled back the last couple of days, and this actually could be presenting a pretty nice opportunity here at the 20-day moving average because it is just 6 cents above it. If you close below the 20-day moving average, you can get out. There's also a little bit of price resistance right in here at about 14. So you're kind of hitting this price support as well. I like it. I think ultimately we got a little cup. I think we're going to work our way back up to 17. So I think the reward to risk favors being on the long side at this point.
All right. And the final one is going to be an ETF, the First Trust Natural Gas ETF, FCG.
Okay, FCG. Well, I'm seeing a lot of sideways action. Let's see if the weekly looks any different. Yeah, this, when I look at this and I know what kind of bull market we've been in, I mean, first of all, natural gas, I don't normally trade natural gas, but I'm just looking at a market that's been soaring. I'm trying to outperform the S&P 500. How am I going to do it with this? It's been very boring. Maybe the short term, looking at the daily chart, let me annotate this. if we pulled back, if I was going to trade this, if we pulled back somewhere close to the 20-day moving average, we would be essentially testing price support, because we did have a lot of overhead movement that failed right at about 21.20, and we finally made the breakout. Now we're starting to weaken. If we can pull back, hit that rising 20-day, I could set up a high reward to risk trade. Doesn't mean it would work, but because I'm just not comfortable that this is literally going to continue uptrending. We just looked at that long-term weekly chart, and it really hasn't been uptrending for quite some time. So this short-term uptrend may prove to be just that, but I would have to manage my risk. So if I could get a pullback to 21.20 or so, 21.25, then I could at least get in with a very tight stop. Otherwise, I would avoid this.
All right, and that completes the 10 in 10. There we go. There are your symbols. I'll have those up as soon as Tom gets me his list. And don't forget to do that. I know you're ducking out right now.
I am getting ready to duck out. I do have to leave a little bit early today, but I did want to wish everybody a great weekend. And I know I'm leaving everyone in great hands here with Aaron for the next 20 minutes or so. But do have a great weekend and be safe. And hopefully I see everybody back here on Monday. And fill out that survey at the end of the show if you don't mind. And as you exit, I'd like to know what you thought of the workshop today. And with that, I am out of here, and I'm going to let you take it over. Have a great weekend, Aaron.
You too. We'll see ya. All right, let's go ahead, and I'm going to take the screen here. We're going to talk a little bit about ChartCon. I won't take up too much of that time. Oh, there's Italy. I want to go back there. Let's see, it's in here. There we go. All right, so if you go to stockcharts.com/ChartCon, it'll bring you to this screen right here. We are having our, I guess every 2 years we have ChartCon. It's our special charting conference. That this year it's going to be on reducing risk in uncharted waters. And right now we have early bird pricing. As this says, it's going to be going up May 5th. So you definitely want to, if you haven't already signed up for it, you'll want to do that. It's an online conference, which is why you're not paying that much money to be a part of this conference, because you don't have to travel. You don't have to get a hotel room and all of that. You can do all of the ChartCon conference from your desk, your iPad, whatever it is you want to do. And we had a great time 2 years ago. These are the featured speakers. I mean, you can't beat this lineup, and they're all going to be talking to you about how to reduce risk, similar to what Tom talked to us about on trading gaps earlier in the year and trading these consolidations, etc. And so I would highly recommend you go ahead and sign up for this, and you'll be able to be a part of it for those 2 days. And you get all of these recordings to yourself, and you can always go back and look at the ones that you want to learn more from. They're always there for you. And the typical session, everybody gets about an hour time to do their particular briefing, and then the day is usually, as you can see, it's about an 8-hour day. So there you go. I recommend you go sign up and take advantage of that early bird pricing as soon as possible. And with that, I'm going to go ahead and move us into our final market update. And here we go. I'm going to do the candle glance, which is the best way to get the entire market on one page. I will add the TSX. And today, I think I will add, let's see, one of these stocks that I did not get to pick that I know everybody wants to see is Google. And here we go. So let's see what's been going on. Well, obviously not a good day for the market. We just continue to travel lower. It looks like we're going to try to set an intraday low and move up off of that right now, but not very successful the previous times we've done that on the Nasdaq and the S&P. You can see that small caps are also suffering right now. Canadian markets, however, are up slightly, and we can see that the Treasury yield is also up, now reading at 29.49. UUP is gapped up and is mostly consolidating now from that area, reading at 23.68. Commodities gapped down on the open, but have been trying to get into positive territory. USO did get into positive territory, but has fallen back down into the negative territory. Gold, we had a big gap down and then started seeing some consolidation. As UUP and gold are mostly reversely correlated, not a surprise to see a gap down on gold with the gap up on the dollar. The VIX is rising, but we're still only seeing readings around 17. That's still considered fairly low. And we can see that Google, as we were talking about the technology stocks, et cetera, we had a great day on Google yesterday that we got a buy signal for decision point on the tech sector, which I wrote about yesterday. But now it's starting to give back some of those gains that we saw yesterday. It did set an intraday low. So far, it's been trying to travel up off of that. Google now reading at 1083.14. Go very quickly to look at our market summary so we can see what has been going on as far as the sectors, who is leading. There we go. And here we are with our sector spiders. And as you can see, financials, the only sector right now in positive territory, maybe due to the treasury yields as they're moving higher. Consumer staples is having the worst day, down over 1.75% for XLP. Technology not far behind that, down over 1.25%, currently reading for XLK at 66.24. U.S. industry indexes, broker dealers, banks are at the top, not a surprise given XLF is the leading sector. Computer technology, retailers, and airlines all falling, and the bottom of the list are laggards. And again, not a surprise when I see that computer technology is the laggard when we're seeing technology as one of the lower sectors. Sweden and Japan are the leaders. Sweden ETF is the only ETF of our international ETFs that we're covering here that is in positive territory, up over 0.5% right now. Taiwan, Malaysia, Mexico, all of those are the laggards, and we can see Taiwan is down over 1.5% currently. And with that, I'm going to complete our final market update, and I'm going to move us into sentiment. Get those charts ready to go. And here we are. So I don't look at all of these charts, but I'm going to give you an idea of what's going on as far as what are investors thinking and feeling, and what are they actually doing with their dollars. And we also look at what the active money managers are doing. So let's take a look at the sentiment. Remember that sentiment is contrarian. So if everybody is very bullish, that's bearish for the market. And if everybody is very, very bearish, that's when you start looking for the reversal to the upside. So I think it's important to keep an eye on sentiment just to know what the pulse is right now. And I'm going to start with our put-call ratio. And again, a reminder, high readings means that investors are bearish. That's bullish for the market. So what I'm looking at right now, as far as the put-call ratios, we had that top. We had investors very bearish, but now they're starting to feel more bullish. And as they feel more bullish, that's more bearish for the market. I'm seeing mostly neutral readings here. So we are falling, but we're not bottoming yet. And that's the bottoms are usually when you start looking for the declines. I don't have those highlighted here, but you can see there that preceded the consolidation zone. What we actually want to look for are tops. So we're currently moving downward. We're sitting mostly in neutral. I would say our put call ratio is very nearly 1 right now. And that's very neutral. All right, AAII, investor sentiment. And here we are. We had a large increase in bullish sentiment, and I'm going to show you here on the thumbnail. I can't annotate it, but you can see that we've had declining tops here on the bulls, and we've now broken out above that. So we're starting to see an increase in bullish sentiment right now. This the AAII is the American Association of Individual Investors. So this is polling pretty much anybody who goes to their website as far as investors are concerned. I believe you can go, I don't think you have to be a member, and put your vote in. Are you bullish or bearish? So this really takes into account kind of the broad market, all of the big group of individual investors, kind of the cats and dogs a little bit too. So there's just a big group there. But when I see them getting more bullish like this, when I see a breakout from declining tops like I'm seeing here on the AAI bulls, that does concern me a little bit. You can see that our ratio is getting higher as well. We're not looking at, a ratio above 2 or at 2. And that's really when we're starting to look at extremes. We're not quite there yet. So I'm looking at this as far as the AAII with that increase in bullish sentiment. I think that's increasing the bearishness in the shorter term. And I'm still feeling bearish in the short term. I did write, again, I've been writing about that this past week in the Decision Point blog. This is the National Association of Active Investment Managers. They report how exposed they are to the market. And currently the exposure is starting to rise. We're not at levels that are extremely overbought, I would say, in this particular instance. We're not seeing that just yet, but we are seeing money managers increasing that exposure. And we are higher than we've seen in a couple of weeks right now. So that elevated position tells me that, they're getting more bullish. Obviously, they're putting more money out there, but they're not extremely bullish. They're kind of mid-range here. So at this point, I'm a little concerned that exposure is increasing, but we're not looking at really large exposure numbers. I mean, you can see right here, the lowest we tended to get in between 2016 and 2017, the lowest was about 50. And right now we're reading at 77.64. Oh, I did note, I was looking at this and I saw that symmetrical triangle that seems to have formed now on the S&P when I look at this monthly chart, or weekly chart, I'm sorry. And that's a continuation pattern. Haven't broken out from that declining tops, but looks like we may. Let's see here. Let's look at the next one I'm going to look at is the RIDEX assets. All right, there is a basket of funds at Guggenheim. They used to be managed by RIDEX, which is why we call it the RIDEX ratio. But there's a basket of funds that are bear funds, that are bull and sector funds, and then they track money market assets. So they report every single night how many assets are in their bear funds, how many assets are in their bull funds, and how many assets are in money markets at the time. So if we follow the cash flow, if we follow where the assets are going, that tells us information about the sentiment and what's going on. I like this far better than the polls. The polls are stick your finger in the wind. Yeah, I'm bullish. I'm bullish. But what are you doing with your money? Oh, I'm actually closing out positions right now. So it's easy to say I'm bullish or I'm bearish, but it's not so easy to follow through in what you're doing on your trading, or to even, tell people what you're doing with your trading. I know a lot of people like to keep that close to the vest. So we can follow this and see what's actually happening. So right now, as I noted, we're seeing mostly stagnation in the bear funds. So we're not getting really an increase in assets over there. What I've noticed is we have been seeing cash being depleted slowly. So money is coming out of, the sidelines and starting to be put into action. But clearly, when you look in the thumbnail here and you can see where we were last week, we were seeing a rise in bull sector and equity funds assets, but now we're seeing a big decline here. Well, not a big decline, but we're near the lows of assets that we've seen in the past year. So that tells me that we're looking at bearish activity. The only good news I would say is that when you see the money market assets going lower, that means people are feeling comfortable enough to put the money in the market. But you want to see that money going into your equities and sector funds, and you don't want them to be going into all the bear funds. So at this point, we're seeing the money not going into equities, but they're really not going into the bear funds either. I think at this point, we're looking at a little bit of drawdown for some of the cash that's coming out. In any case, I'm watching the RIDEX ratio, and I'm looking for a breakout from that ratio. You can see that when we get breakouts on these ratios, like we did back here in March, that marks a market bottom. So at this point, you know, we're starting it to head lower. I suspect we're going to head lower still. But after that, that's when, after the short term, we should start looking for an intermediate term bounce. I'm going to just give you a quick peek at my decision point indicator charts. I have just a few minutes, and so I will do that. I'm going to look at, I want to show you why I'm bearish in the short term, but I'm bullish in the intermediate term. I am bearish in the short term, and you can see I've been bearish to neutral to bearish, but I have been feeling bearish about the market whenever I look at these price charts and when I look at these indicators. We hit extremely overbought territory, and even though we've had those two declines, this is as of yesterday's close. These indicators don't go final until after the close. So we're looking at yesterday's activity. But I can guarantee you when we look at a OHLC bar and a decline of almost 1%, we're going to see these indicators continue to move from that overbought territory into more neutral territory. So the problem is you get overbought readings and then you should expect them to unwind, and they unwind on price declines typically. So I don't think short term we're looking too good as far as the decision point indicators are concerned. However, intermediate term is looking good. I have breakouts now from these declining tops on these indicators. They've gotten those positive crossovers. They continue to rise in the intermediate term. So what this is telling me is that though we are in for a short-term decline, and I think we have a little bit more to go, after that occurs, we should be okay. We should be okay in the intermediate term, and I would be watching for a breakout from this declining tops trend line. I think that's going to be the next important signpost that we have. So with that, I am going to conclude my sentiment charts, and here is the recap for you. And you can see that we've got the put-call ratio continuing lower, and that is neutral to bearish for the market. And then we also are seeing a high bull-bear ratio on the AAII. It's not extreme, but it does tell you investors are more bullish, and that can be bearish for the market. Finally, the increase in exposure readings by the investment managers, that can be bearish for the market. So I think in the short term, as we've been talking, that's the problem. RIDEX ratio is really neutral at this point because we're seeing a stagnation in the bear funds, slight decline in cash and equities. So I don't think we're really getting a whole lot of information out of that chart right now. So overall, in conclusion, I would have to say that sentiment is somewhat bullish among investors and many managers, and that is neutral to bearish for the market. And so to me, that's what I'm seeing, a short-term bearish bias, moving neutral, and then hopefully at that point, when we get to the intermediate term, we're going to start seeing that move to the upside and get a nice rally going. And with that, let me go over our weekly schedule so we can see what's going to happen next week. Gaddis Rose is going to be with us on Wednesday of next week. I've been dying to get a hold of him, so it's great to see he'll be on the show with us. I will have a workshop probably on moving averages on Thursday, and on Friday we will have everything stock charts. And with that, I do want to thank you all for being with us today. Please remember to complete our survey as you exit. We do love to get your feedback and hear what you think of Market Watchers Live. It helps us with doing the show. And as a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, noon to 1:30 p.m. Eastern. Have a great weekend and afternoon, and we'll see you back here on Monday. Happy trading.